The late 19th and early 20th centuries were marked by rapid industrial growth and consolidation as America's economy progressed into new levels of complexity. The laissez-faire environment of the country gave industries a great deal of economic freedom. In this context, capitalists amassed great fortunes by developing infrastructure and using the lack of financial regulation to their advantage. The growing progressive movement of the time looked to limit these supposed robber barons and to prevent exploitation of a deregulated economy. America's vast economy needed a central bank to manage its increasing complexity and to prevent unfair business practices. Central banking was always controversial in America because it went against free market capitalism, a value the country had been built upon. While Alexander Hamilton supported a central bank when he introduced the first Bank of the United States in 1790, others such as Jefferson opposed it. 5 years later, the Second National Bank was formed, but Andrew Jackson did not renew its charter in 1836, leaving America without a central bank just as the country was entering the Industrial Revolution. In order to keep its economy stable, America needed a central bank to conduct the nation's monetary policy, maintain stability of the financial system, supervise and regulate banking institutions, and provide financial services to depository organizations. While not every country's central bank performs all four functions, each is critical to the smooth functioning of a modern economy. At the turn of the century, one individual's actions would lead to the reemergence of an American central bank, the Federal Reserve. John Pierpont Morgan was the son of banking magnate Junius Spencer Morgan. He joined his father's company following his education at some of the finest business institutions in Europe. After the death of his father in 1890, J.P.Morgan expanded his power by investing in a wide array of industries. He was greedy, arrogant, but also anxious to do his job for his clients. In 1901, Morgan bought and merged Carnegie Steel with other large steel companies to create U.S. Steel, the first billion-dollar company. He controlled 40% of the liquid commercial and financial capital in the United States. Just like a central bank, Morgan had vast control over the money supply. J.P.Morgan took on the role of a central bank during financial crises in the panics of 1893 and 1907. In both situations, he essentially conducted the nation's money supply and maintained stability of the financial system. Following these panics, there was a consensus for an overarching system similar to what Morgan had provided. Moreover, Congress did not trust an individual to maintain the safety of the nation's finance. J.P.Morgan's actions were integral to the creation of the Federal Reserve in 1913, and his legacy continues to impact modern economic policy. Not only did he influence the Federal Reserve's implementation, but he also showed the country that it needed to prevent those like him from becoming too powerful. J.P.Morgan first acted as a central bank in the Panic of 1893, the worst economic crisis America had suffered to that point. Morgan organized European lenders to purchase $65 million worth of government bonds with gold to replenish the money supply. Though Morgan restored the United States Treasury's gold reserves, he marked up the prices to benefit himself, drawing criticism. However, Morgan's controversial legacy in American banking was not defined until the Panic of 1907. In 1907, J.P.Morgan acted as a central bank and stabilized the economy as he had done in 1893. The scare began when a group of financiers associated with the Knickerbocker Trust Company failed to corner United Copper and lost millions of dollars. A crisis of confidence swept through Knickerbocker's depositors, and they began to pull money out of the trust. As Knickerbocker was the third largest trust company in New York, other banking institutions feared they would end up in a similar situation. They stopped loaning money, shrinking the money supply. This led to the failure of other banks and trusts and the decline of the stock market. As the dominant banker in the city, those in need sought Morgan's aid. He gathered the leading bankers of the city for funding and forced a resolution. Morgan concluded that Knickerbocker was not worth saving because it was poorly run. A bank, Morgan said, if it transacts its business right, will get its share of the business. He invested in well-managed companies such as the Trust Company of America. Morgan's actions garnered huge support from the banking elite. Even Secretary of the Treasury, George B. Cortelyou, traveled to New York and pledged $25 million government dollars to Morgan's cause. He also received approval from President Roosevelt to merge Tennessee Coal, Iron and Railroad, one of the largest corporations, with U.S. Steel. This violated the Sherman Antitrust Act, a piece of legislation sparked by the Progressive Era. Although Morgan had guided the country through another financial crisis, the public feared he had too much power. Senator Robert La Follette, a leading progressive, criticized Morgan for violating the Sherman Antitrust Act and using the economic crisis to profit. He used the merger as evidence, for it benefited U.S. Steel enormously. In essence, Morgan acted in the same manner as a central bank during both the Panic of 1893 and of 1907. He conducted the nation's money supply by lending funds to banks and trusts that he believed could use it. In addition, Morgan instructed the takeover of TC&I by U.S. Steel. These actions maintained stability of the financial system by keeping well-managed companies from failing. Negligent bankers primarily caused the Panic of 1907. George E. Roberts wrote in 1908 that bankers were not familiar with some of the fundamental principles of finance to which the country as a whole must conform. If a regulatory body had been in place, the Panic of 1907 could have been avoided. Future President Woodrow Wilson said at the time, "All this trouble could be averted if we appointed a committee of 6 or 7 public-spirited men like J.P.Morgan to handle the affairs of our country. The job of creating and enforcing banking regulation falls under the criteria of a central bank." Thus, the need for one emerged. Following the Panic of 1907, Congress moved to reinstitute a central bank. In order to dispense money similarly to Morgan, they passed the Aldrich-Vreeland Act in 1908 to prevent the causes of the panic by providing an emergency money pool. In 1910, Morgan lent his property at Jekyll Island in Georgia to Senator Aldrich as a place to examine the country's banking system. Although he was not present, Morgan's views on national finance still had influence on the deliberations. 3 out of the 8 men Aldrich assembled belonged to companies controlled by Morgan. These men, in essence, drafted a plan for a central bank. Benjamin Strong, Morgan's emissary to Jekyll Island, would become governor of the New York Federal Reserve and remain so until his death in 1928. These men not only drafted the foundation of the Federal Reserve Act of 1913, but also influenced its policy. In the 1912 Peugeot hearings, the House Committee on Banking and Currency investigated Morgan. Some thought he exploited the system and needed to be controlled. In the hearings, Congress relentlessly questioned Morgan about his banking methods. His self-righteous manner throughout the hearing portrayed him as a stereotypical robber baron. The fear of an economic tyrant, coupled with the fear of another banking panic, motivated Congress to pass the progressively influenced Federal Reserve Act of 1913. Not only did J.P.Morgan influence the implementation of the Federal Reserve, but he also demonstrated to the country that it needed to prevent those like him from becoming too powerful. The Federal Reserve Act, founded on Senator Aldrich's meetings with Morgan's men at Morgan's Jekyll Island, instituted a central bank in America for the first time in 75 years. The Federal Reserve Act mandated that all nationally chartered banks be a part of the Federal Reserve System. This system supervised and regulated these banks and set stricter reserve requirements. These measures countered the deregulation and minimal reserve requirements present in the Panic of 1907. Federal Reserve banks could act as lenders of last resort, a role Morgan took during the panics of 1893 and 1907. A man of the stature and probity of J.P.Morgan might be able to avert financial calamity in the future, but there was no guarantee that there would be such a man available. With such a large and complex banking system, the government needed some way to control the nation's financial institutions in case of crisis. While J.P.Morgan conveniently filled this void during some of America's worst economic times, he could not be the permanent solution. Many feared the power he wielded. Thus, Congress unanimously passed the Federal Reserve Act to protect from future panics. The Federal Reserve has built the base for America's economy. While it did make mistakes during the Great Depression, the reforms from that time period led to a very stable central bank. Straying from the system has proven to have consequences for the nation's economy. The current economic crisis was caused in part by changes that deregulated companies and banks, allowing them to pose systemic risk that could severely damage the economy.
The 4 elements of proper banking regulation that have protected us from a massive commercial banking run and crisis for decades. We lacked all of that with Wall Street.
This happened both in 1907 and in today's economic crisis. In our current crisis, the Federal Reserve System has made mistakes. It has not kept up with an increasingly complex economic system. Our big mistake this time, a mistake Morgan would not have made, was to allow a lot of bank-like institutions to escape regulation and supervision completely. J.P.Morgan may be remembered as an ancestor of J.P.Morgan Chase, as a robber baron, or as a hero of 2 economic crises. But most importantly, J.P.Morgan was integral to the creation and the philosophy of the Federal Reserve.